Option trading has a really steep learning curve due to the number of factors influencing the price. Unlike futures or other Delta 1 instruments that move closely with the price of the underlying, options depend on a combination of first, second, and even third order Greeks that all move the price of the option in ways that are hard to model, let alone intuitively grasp. So, one of the first problems someone faces when entering this world is trying to make sense of what a cheap or expensive option looks like and how to recognize both. This is what we are here to explain. There are a lot of things to consider when making the distinction if an option is cheap or not. But the first and most important thing you should start with is implied volatility. Implied volatility is often used as a substitution to the price of an option. The reason being that it is the only unknown variable in an option pricing model, such as the Black-Scholes. The interest rate, time to expiry, strike, and spot price are all known. What we don't know is the future volatility of the underlying stock, or if you want to get fancy, the annualized standard deviation used in the cumulative standard normal distribution function. While it might sound nerdy, it's good enough for you to know that it is this weird part of the equation. The first one is actually the options delta, and the second is the risk-adjusted probability of the option being exercised. But this is not as important. What you need to know is that to calculate them both, and in the end, calculate the option price itself, you need the implied volatility. And this is the only unknown variable that we have to estimate somehow. All of this allows us to plug the price of the option from the option chain and the other known variables to reverse engineer our way to the implied volatility. Thankfully, options trading software does this for you. So you can observe volatilities directly from the option chain. If an option with all other things staying the same is more expensive in dollar terms, it has to have a higher implied volatility to compensate for it. For example, if we have two European-style options, all on the same underlying with the same expiry date and strike and with a constant risk-free interest rate, the one that costs 20 bucks will have to have a higher implied volatility than the one costing 10. Implied volatility is the standard deviation move expected from the underlying in annualized terms. You can get to the daily expected move from it by dividing the number by the square root of trading days in a year, which is 16. This means that an option with an implied volatility of 16 has a 1% expected move per day until expiry. An option that is priced higher is also expected to move more, so a 20 vol option will be more expensive than a 16 vol option since it is expected to move more. This connection allows us to think of option prices in terms of implied volatilities on their own, without giving too much attention to the nominal dollar amount. So, in the most basic way, you can say that the 20 volt priced option is maybe expensive, while if it were priced at 16 volt, it might be cheap. Now, how do you make the distinction if the 16 vol option is actually cheap or not? A common mistake is just looking at the current implied level and comparing it to some historical time period of implied volatilities. And if the current IV is located in the top quintile, for example, you can say it is historically expensive. Same for the reverse. If it is in the bottom 20% of all occurrences, you can think of it as cheap. This is a very simplified way of looking at it, and while it might sometimes make sense to do this, it is often wrong. An option, let's say 1 month at the money call, that is priced at the highest implied volatility a 1 month at the money call has ever been priced for that stock, still might be cheap. Also, an option priced at 7 vol while it has never been priced for less than 10 vol still might be expensive. Options priced this way often have a very good reason to be this low or high historically. A drug maker waiting approval for its cancer-curing medicine that it just developed might be trading at above 101 month vol. And while it has never been this highly priced, if they get the approval, the stock might increase tenfold. So, if you have done your research and think that such an announcement might move the price of the stock 10 times, the 100 volume 1 month option could still be cheap. Let's imagine another scenario. A volatile coffee producer whose stock was closely tied to the price of its input announces it will start hedging the commodity via futures, and the implied volatility starts falling to a historical low. If you miss the news, you might think, this is the lowest it has ever been, and you are going to buy, not knowing that the stock doesn't have a reason to move as much as it did historically anymore. This is why if you see something like this, you shouldn't run to buy it, thinking to yourself, I'm getting such a good deal. It has never been this cheap. It's most likely cheap for a reason. This introduces us to something else, the volatility risk premium. This is the difference of implied future volatility and the volatility actually realized for the stock. It can be positive or negative. Since the implied volatility is what we are estimating the future volatility is, and we cannot actually know what it will be beforehand, or if it will be above or below what is implied, we often calculate the volatility risk premium by subtracting the historical realized volatility of the stock, as that is something we have. The 1 month VRP for something with an implied volatility of 25 and a realized of 20 over the last 30 days would then be 5. 25 minus 20. This leads us to another mistake people make, looking at this number, again, in a historical context, and determining if something is cheap or expensive. If the VRP is in the bottom 20th percentile of all observations, it doesn't mean it's cheap. The problem lies in the realized part of the calculation. If something has been moving only 1% daily for the last week, and the current 1 week implied volatility forecast 2% moves, this doesn't make the option automatically expensive. As always, it is probably expensive for a reason. The movement over the last week doesn't mean the stock will continue indefinitely in moving that way, and most likely some important catalyst ahead is what prices the current implied volatility so high. The important takeaway from all of this is that you have to create your own scenarios and forecasts of how the stock will behave. If your view differentiates from what is currently priced, you might get a cheap deal on something that other people have not yet caught on. But be careful, most often than not, if something looks cheap or expensive, it is probably for a reason. There are numerous other factors that you will start thinking of once you get more in depth into options. When buying or selling an option, you are gaining exposure to all of the Greeks in some specific way. You might trade the option because of one particular Greek, and therefore might start thinking to yourself, I am paying this much theta for this much gamma exposure. Considering my view and some historical context, I think it is a good deal and a bet I am willing to take. This will all come with experience and time in the market.